Many parts of the U.S. government have been closing up shop.
There's no common ground. There is every possibility this shutdown will last longer than 35 days. If it does, that's when it has a real impact on the economy.
Are we heading for a market crash? Of course, AI has real benefits, but whatever success that they might have has already been massively overcapitalized. Hey there and welcome to The Dip, your essential briefing on money stories that cross borders. I'm Daniel.
And I'm Kassandra. Coming up, is AI leading us to the next massive market crash? Plus, we'll ask whether Trump's new pharma tariffs will help lower drug prices in the U.S. But first, the word on everybody's lips is going to be shutdown. Many parts of the U.S. government have been closing up shop over the last couple of days as Republicans and Democrats fight about a spending bill. Now, I know before you go into the comments, that is a vast oversimplification. But before we get into the politics and the policy weeds, we actually want to zoom out and think about how this is affecting business.
Yeah, so just chill out listen carefully before you comment. We're going to talk to Elizabeth Stevens. She's the Managing Director of Geopolitical Risk Advisory and an Investment and Country Risk Advisor. Elizabeth, thank you very much for joining us today.
Now, Elizabeth, you're in the risk analysis business. What are you telling your clients about the risks of investing in the U.S. right now?
Well, associated with the shutdown, I'm telling them not to panic. This isn't actually an unusual event. So back in 2018-19, US government shut down for 35 days, in part over disputes over funding for Trump's border wall. 1995-96, the government shut down under the Clinton administration. That was around a dispute over funding cuts. And 2013, government shut down 13 days under Obama over disputes around the Affordable Care Act. So this isn't unusual. What is different this time is the level of acrimony between the Republicans and the Democrats. And Trump has said very clearly, if we're going into shutdown, then we will use this as an opportunity for government layoffs. Now, usually when there's a government shutdown, government employees are furloughed. So they stay at home. Essential workers go to work. They're working unpaid. When the government reopens, when agreement on debt financing is reached, workers receive their back pay. But what Trump is saying this time is, well, if Democrats are saying we don't need those workers to work, fine, I'm going to fire them. And if that happens, that will have a medium-term impact on the economy because payroll numbers will decrease. I'm telling clients that we're going to see a shortage of data coming from the US. We're unlikely to get payroll data for September, and we're not going to get economic growth statistics, accurate ones, while the government shut down. So that's a cause for concern if you're planning major new investments. For those companies already in the US market, nothing's going to change for the next few weeks. In terms of short-term investments, we saw overnight before the shutdown, we saw an uptick in the price of Bitcoin, and gold prices have reached an all-time high as some investors move out of US stocks. But the US stock market's hardly moved. Look at what the rating agencies are saying. They don't see a government shutdown as a credit event.
Okay, but what is the policy that's at the heart of this? What are they arguing about? Why has it come to this shutdown?
Well, they're arguing about, in effect, different ideologies. There is such a divide now between the Democratic Party and the Republican Party. And that isn't just a divide because Trump is president. This divide in American politics has grown since the end of the Cold War. It's like there's no external enemy to focus our attention on. So Americans have started fighting between themselves. And with MAGA and Trump in the White House, it's like this is reaching, I was going to say the zenith, but we don't actually know because we don't know what's going to happen next.
Right.
So the dispute at the moment is really over the one big, beautiful bill. It was passed by the Senate and by Congress. There was, huge disagreements over it because part of the rationale is to maintain tax cuts that were introduced in 2017, and it's to cut care for about 22 million Americans. So Trump wants his tax cuts agreed. The Democrats want him to agree not to cut Medicare and Medicaid. That's what the dispute is about.
So extending those Affordable Care Act provisions would satisfy the Democrats, I guess. But do you think that's all it will take to end this particular shutdown, or will it take more than that?
It's likely to take more than that. I mean, part depends on public opinion. The Democrats think they're safe defending affordable care. Trump thinks he's safe defending his tax cuts. With their bases, they're both right. And that is the challenge. If you speak to Congress people in the US on either side, most of them are actually quite reasonable, and they know what they need to do. They know overall, we need to bring debt level down to about 3%. And to do that, we've got to raise some taxes. We're going to cut some welfare. How do you do that when your voters are either saying to you, don't cut taxes, don't cut welfare? There's no meeting in the middle. And Congress is really the reflection of a very polarized society. So unless you're a Republican who's willing to say, yeah, actually, we need to pay some people benefits, or a Democrat who's willing to say, actually, too high taxes, they're bad for business, there's no common ground. So, and with Trump taking sort of action in the immigration space as well, it's a highly charged political environment. So we're going to need to see quite significant concessions on both sides. So There is every possibility this shutdown will last longer than 35 days. If it does, that's when it has a real impact on, it has an impact on the secondary economy. Workers who aren't being paid don't spend. We'll see a contraction then in growth. We expect a contraction of probably 0.1, 0.2% of economic activity a week during shutdown. I believe the last shutdown cost the US economy $11 billion. $3 billion of that was never regained. So If this continues for 8-9 weeks, you're going to see $3 to $5 billion wiped off economic output. Think of the size of the economy. It's not a huge figure, but why lose money when you don't have to?
Fair enough. Elizabeth, you're blowing my mind in quite a few ways. Most importantly, that politicians, most of them might be reasonable, but I won't dwell on that for now. One thing that's making me wonder, I was pretty surprised at how zen you're being with this shutdown right now, especially because a lot of the headlines we're seeing out of the U.S., it kind of seems like it's, bright, blinking red light. But for you, at what point does a shutdown move from manageable disruption to systemic risk in the U.S. economy? We've talked about these numbers, but where's the line for you?
I think if this shutdown goes into a number of months, that would be completely unprecedented. That would make investors incredibly nervous. We would see the withdrawal of investments from the US. Right now, we're 2 days in? Markets aren't becoming overly nervous. We've got various other challenges going on with the US economy at the moment. We've had the unprecedented level of tariffs that were imposed in April and have been renegotiated on and off since then. But, those tariffs are bearing fruit in some respects. They've brought in about $300 billion so far. We don't know yet what impact they're going to have on inflation in the US. With the shutdown, the numbers are going to be delayed still further. But when we look at risk in the US, we also have to compare it to risk in other markets. If you're not investing in the US, where are you going to move your money? So we've seen inflows into the Eurozone, but is the Eurozone really a safe haven? It has incredibly low productivity, and there isn't much upside at the moment. We're not expecting significant growth in that market. So in terms of options for investors, they're relatively limited in this new heightened world of geopolitical risk. Where is actually a safe haven? Well, investors seem to think it's gold and Bitcoin.
So, Elizabeth, is your base case for this that it is going to be significantly extended as far as, you mentioned the other shutdowns go. Mm-hmm. The average shutdown in the US is about 8 days. It's not that long. You think it could be longer than that?
I think potentially, given the standoff between the executive and the legislature at present. But we also need to remember this is a personalized administration under Trump. So anything can happen. You potentially expect the unexpected. But if the Republicans do see this as a way to cut government payroll, which is part of their objective, then they do have an incentive to continue with the shutdown. And we've seen in the past, voters don't blame their own politicians for the shutdown. Do they blame the other side? Potentially. But, people, voting patterns in America are actually very, very set. People don't usually change their allegiance, and the midterms are still not until next year. That's a long time in politics.
This almost goes without saying, but I'm in the talking job, so I will say it anyway. The U.S. is really central to the worldwide economy, right? And it's a top destination for goods, especially from the European Union. Could a government shutdown mean less demand for EU goods, or what effects are you anticipating?
Across the board, it could result in a decrease in demand for all goods, but that's kind of into the medium term, and that's really initially amongst government workers because they're the ones who are not going to be paid. It's not amongst the private sector. For us to see that, we'd be looking at this going on for 3-6 more months, which even in this heightened politically antagonistic climate is unlikely. And you're right, this is the central economy in the world. It's the reserve currency, but the economy, despite the challenges at the moment, is proving remarkably resilient. And historically, government shutdowns haven't unsettled that. There's no sign at the moment the rating agencies are going to downgrade America's sovereign credit rating. So, in some respects, it will continue business as usual.
So do you think that means that Europe is fairly shielded from this, or do you think that there are going to eventually be ripple effects that are felt abroad?
Depends how long the shutdown lasts
for. Yeah.
But Europe is already experiencing the ripple effects from the tariffs.
Absolutely.
So you could say at the moment, everyone is accustomed to the unexpected coming from the US. So we're all in heightened risk mode anyway. We're all now, as business people, more accustomed to managing the unexpected. So I think this ironically, perhaps has less impact than it would have done a year ago because we're already dealing with so much uncertainty.
Elizabeth, you've alluded to this already, but one of the things that the government is good at is releasing data, and then businesses can parse through that data to try to read the tea leaves about how they should move forward, especially prioritizing investments. So I'm wondering, we're seeing a delayed jobs report. We're anticipating delays in future jobs report as this kind of snowballs behind it. What could this mean for businesses who are trying to read the tea leaves and see which way the U.S. economy is headed?
Well, there was already concern over jobs report data. Obviously, Trump has said recently that the jobs figures weren't what he wanted. They were revised down. It's fake news. He wants to fire people from the agency. So we were already seeing uncertainty around that data. We will see delays in the publication of the data. Yeah, if you're looking at long-term investment plays in the US, that will start to unsettle people if we don't have any data for the next 2 to 3 or more months.
Okay, so a lot of this we're talking about at the federal level. Do you have any kind of indication that the states, the municipalities can absorb some of this shock, or are they just going to be rolled over by it just as much as anyone else?
Well, theoretically, the states could produce their own payroll data. There seems to be a debate at the moment that this consensus seems to be that's actually not going to happen at the moment. Potentially, we'll see some states publishing their own information. Obviously, government funding to the states is key as well. But states like California, their budgets are larger than their economies than some countries. They do have remarkable ability to absorb these shocks.
Let's stay with the U.S. economy now, because Daniel, you've actually been looking at the markets. And one thing is certain, for now at least, markets are red hot.
Yeah, you might have heard about worries about the AI bubble. So this idea that investors are putting far too much money into AI-related companies than can actually be justified. And some of those indicators, like you mentioned, they're flashing red all over the place.
So what are some of these warning signs? What's flashing red?
Well, there's a great website recommendation that I can give you, and that is currentmarketvaluation.com. It's got a bunch of these indicators, right? And one of them is the Buffett indicator, named after
Warren Buffett.
Hey, you got it right. I mean, this one's my favorite. It shows that US equities are worth more than double US GDP right now. So Warren Buffett says that it should be, this indicator should be around 75%, but instead it's 217%.
That sounds bad.
Yeah, and investors are watching all of these kinds of indicators that are on there, whether it's valuation indicators, recession indicators, and they're pointing in a worrying direction, that's for sure.
Okay, but this isn't really just something that like your Wolf of Wall Street kind of hotshot investors should be worried about, right?
Right, so if we're heading for a market crash, and it's a big if, many analysts don't agree, right, even though a lot of these indicators are pointing out that it could happen. Well, it should at least concern everyone. So firstly, a great many people are invested in the stock market, even if they're not doing it directly, because their pension money is in there. Mm-hmm. And then second of all, if the likes of Tesla take a big hit, then they're going to have to start reducing their workforce in their factories around the world. And in that sense, it could have a ripple effect elsewhere, and for many other reasons too. But those are the ones that are most present at mind when you hear about these things.
Okay, so keeping all that in mind, you spoke to someone who knows a bit more about this, didn't you?
Yeah, Dan Ives from Wedbush Securities. So you might have seen him all over the news.
Yeah.
And he's definitely a skeptic when it comes to the idea of an AI bubble. So I started off by asking him to give it to us straight, essentially. So one, are we heading into an AI bubble? And two, are we heading for a market crash?
No. I mean, look, I've covered tech stocks back in the late 90s through the dot-com bubble and burst. This is nowhere near there because of the spending, because of the numbers. It's a true fourth industrial revolution. Look, there's going to be more money spent in the next 2 years in tech infrastructure than the last 10 years combined. That's why, in my opinion, you can't just paint it with a brush and say it's a market bubble. We've talked with you over the years. We believe this is year 3 of an 8 to 10 year build out.
Okay. And so you often say that this is just the first innings of this particular tech revolution.
And now second inning.
Yeah. And so, but when we see that Nvidia is already bigger than Amazon and Tesla combined, for many that is already a red flag. So what would be your red flags where it would start to remind you of the dot-com bubble of 99?
But I would tell you on Nvidia, like there's one chip in the world fueling the AI revolution, and it's led by Godfather of AI, Jensen Nvidia. Today, think about AI. 3% of companies in the US have gone through it. Europe, 0. Asia ex China, 0. Rest of the world just starting. Sovereigns, everyone else. Look, if you said to me, what's the thing that I look for as a red flag? It's the use cases aren't working. Companies that went down deployment 6 months ago, they're starting to cut spending. That to me is what I focus on. Because as the use cases expand and as the infrastructure build outs here, it's an arms race. I view this much more of a 1996 moment than the 1999-2000 bubble moment relative to where we are.
Okay, but it's not like 1,000pets.coms risk going out of business, but we have like
No,
5
that's a great,
or 7 kind of principal firms which are the engines of the growth in stocks at the moment. So
phenomenal example on the pets.com.
But does that mean that we are just that there's even more of a bigger systemic risk because of the monopoly-like scenario that we're in at the moment in terms of these few companies controlling so much of this growth in the market? So if one or two of them trip, then the others might fall.
But that's today in terms of this is spreading to the rest of enterprise and sovereigns around the world. And these are companies that have $1 trillion in the balance sheet and generate $350 billion in cash a year. I get what you're saying, but I view this much more of the beginning of the consumer enterprise build. Look, it's my view, 5 years from now, 20% of cars are going to be autonomous. 1 of every 12 to 15 households is going to have a robot. Humanoid. So I'm just trying to give you an example like how I see it.
Okay. But it's clear that AI companies are making very useful tools, revolutionary tools, you could say. You've mentioned a couple of examples. But it seems at the moment what we have is an issue of integration. So ChatGPT might be great, but companies don't necessarily know how to apply it to their use case. And so in that scenario, they are less likely to hand OpenAI their cash. Do you think investors are taking that into account?
I would view it a little differently in terms of like right now is the enterprise AI build out. That's at Palantir, Microsoft, Oracle, Nvidia. The consumer AI revolution comes over the next 1-2 years. So I think when you think about, you have to think about it in like a multi-pronged build out.
Okay, so let's dig into one recent example. NVIDIA is essentially writing OpenAI a check the size of a medium-sized country's economy, $100 billion. And so NVIDIA gives OpenAI cash. OpenAI spends billions buying NVIDIA chips. NVIDIA books revenue. The cycle continues. Are they just gaming the system here? Or is this cash actually going to help both companies to grow?
I mean, NVIDIA, for every dollar they spent, they get $12 to $15 back in revenue. So I understand some of the worries there, but it's actually just, it's, look, you're building Dubai where there's just desert. You're building Vegas where there's just, like, I'm just trying to explain, like, you are now building the infrastructure for the next 30, 40 years.
Okay, so what about regulation, though, as a risk here? So NVIDIA is essentially locking, even if it's slightly loose lock, OpenAI into buying its chips, which reduces competition. So doesn't that throw open the possibility of legal challenges, especially when money is going to be chasing cheaper computing power and the whole future of this industry is bound up in the price of these chips?
Look, there is regulatory risk, like there always is, but I think a lot of it is going to be about self-regulatory, as it all plays out. I also think that there's an arms race happening, right, between US and China. What does regulatory do? Throws sand in the gears. Who wins? China. So you have to also remember, like, that's also a dynamic that's starting to play out, in terms of US versus China, in terms of this dynamic. So that, look, to me, regulatory will be there, but I don't see that it slows down the AI revolution.
Okay, but this kind of highlights one of the key risks. At the moment, we can't imagine any other companies catching up even close to what NVIDIA is doing right now. But a bit further down the line, what if China or the radical scenario, even Europe, start catching up with some of these companies? Are US valuations just assuming that a kind of monopoly like that will continue? And if something comes along to undermine that, that kind of blows that case open, doesn't it?
No, that's a great question. I don't view it like I view it like you also have to play names like AMD, Broadcom, Huawei in China. Like, I don't view this as just US is going to own. US has significant lead, but it speaks to what the UK is now doing. Look what the UK is trying to do with investments. Look what's happened in the Middle East. There will be massive competition across the board, but it has to ultimately play out.
Okay, and you've said that if there are any sort of pullbacks, then those are also buying opportunities, and so we shouldn't necessarily fear some slight corrections if they do come. Though you've said quite clearly that you're not expecting anything like a crash. But what if we don't just see a dip? If it's more like a 2 to 3 year grind downward, like the dot-com crash, what convinces you that this time would be different? That if there's anything, it would just be a minor correction rather than the full-on crash
Because
that
it's what's being built. It's the it's the spec. This is the future. Autonomous robotics, humanoids, AI for enterprise, AI for consumer. Like, it's like this is, if you go back to, that period, that was really about, like, you didn't have the business cases. You had upside down business models. That's why look, and that's why, look, 3 million air miles the last 25 years. Like, we see it around the world, right? So that's why, like, I also think you gotta be careful. You can't just call it like in a bubble and valuation, because I think also, like, many investors have missed every transformational tech stock the last 20 years because they just focus on 1 year valuation.
So you're saying that regardless of, let's say, the Buffett indicator, price to earnings ratio, price to sales being through the roof, being hot, that other analysts would say point to an overheating market right now. You're saying that what is different about AI is it's so transformatory, and that the
Correct.
players like NVIDIA are so far ahead, and that the money, the spending is there, that we can actually put aside these historical indicators for the most part, because this is just a different kind of revolution.
It's a different type of revolution, and the street's underestimating numbers massively in the next few years. CapEx come into this year was go back a year ago, it was going to be 230 billion. It's 350.
And of course, thanks to Dan Ives there making his podcast debut. But other Dan in the room, not over the internet Dan, it's fair to say that Dan Ives is in the optimist camp.
Yeah, so let's look at the pessimist camp, or as they might call themselves, the realist camp.
Right.
So look at Bill Smead, for example. He's a veteran value investor, and he disagrees with what Dan just told us. So Dan says that this AI wave is fundamentally different from the technologies of the past. But Bill told Business Insider, we're in the crazy stage. It is late 1999, the dot-com crash, right? This is, from a fundamental standpoint, identical to all the past major manias. We're bumping up against history real hard right now. And what he said, of course, AI has real benefits, but whatever success that they might have has already been massively overcapitalized.
You've been in the details with this, but as we kind of zoom out, maybe you come up for air from being down swimming in the dip down there. What do you make of this?
Well, so first of all, no one should take my financial advice. I just want to make that nice and clear.
From a podcast? No.
No. But I'm much more in Bill's direction than Dan's direction. So Dan Ives is a fantastic analyst. He's had many right calls over the years, and he's a very fantastic guy for breaking down these subjects. But I just don't feel like I can agree with his argument, to be honest. Every bubble claims that it's the exception. We had that with the dot-com crash as well. Of course, the internet was always going to be the major technology of the future, and it has been, of course. That doesn't mean that you can justify some of the types of investment decisions that are going on. The dot-com bust showed that the tech can be real, but the valuations can still be insane. It's when you've got like 10 years or 20 years of profit baked into valuations, when you can't even guarantee that while the technology might be around, this particular company might not be, because you cannot predict what will happen with every single company that's out there. And when it comes to AI models could converge, as in that they get to pretty much the same level of capability, that there's not that much difference between them, and that progress on them is just edging forward bit by bit, and so there's not much difference. It could be that AI open source models, for example, start to eat away at the profits of these big companies. Essentially, the models become commodities by themselves. Of course, there's other areas where you will have moats in terms of like the infrastructure. Not everyone can own these massive data centers that it takes to power these AIs. But if only monopolists survive in this kind of scenario, certainly the one that we're in right now, where we have just a few major players, then how do you guarantee that you're going to be the monopolist that comes out on top? And I just don't see the scenario in which we can guarantee that OpenAI, for example, is going to come out on top 10 or 20 years down the line, as some of these valuations are predicting, right? Now, when it comes to OpenAI, of course, they're going to have to raise more and more cash. It's a very cash-hungry business that they're in right now. And it's likely going to IPO at some point. It's going to go public. You'll be able to buy shares in OpenAI. It's not made any announcements, but it seems that that's just the way it's going to have to go in order to be able to get enough cash. And you might say, well, surely this would be good news if we're worried about an AI bubble. This should weaken that possibility, because you've got more companies then to spread your money around if you want to invest in AI. But the fact is, OpenAI is such a big player. It just creates a second gravity well alongside NVIDIA, sucking in as much cash as possible.
And they're already quite intertwined, those two companies.
Absolutely. So, of course, you've got the vertical integration of NVIDIA investing $100 billion into OpenAI in order to kind of secure the chip pipeline, that they can predict ahead what they're going to have to need.
A guaranteed customer, basically.
Exactly. But the issue with that is when you create another NVIDIA in the stock market, that it's just going to hoover up all of that investor cash and concentrate more of the risk into those two companies. And there's the risk of disappointment, because when OpenAI has to open its books and you see whether a lot of their predictions are actually more bluster, if that happens,
Right.
then that will also have that kind of negative effect, which a lot of people are worried about. That could be the thing which bursts the AI bubble. There could be many things. That's what we're so worried about now.
Right. That's the hard part.
We're looking around all of the corners trying to find out what the thing that could come along to prick this bubble. My prediction is, though, without significant breakthroughs in AI in the next 1 or 2 years.
Okay.
Without companies better integrating AI, because a lot of offices, they might have an LLM that they can access, but they don't necessarily utilize it to its full capability to get those productivity gains.
Right.
So without better integration, AI spending could stall. I mean, that is a serious risk. Again, exempting any breakthrough or any major changes, the worry is that the cash will not start to flow like the AI companies want it to. And then we could end up with the kind of grinding drawdown that we saw in just post-99 with Cisco, Intel, Oracle, and the likes. All companies which continued on. I mean, Oracle is one of the most valuable firms at the moment, and Larry Ellison got a massive $70 billion boost to his net worth.
Best friends with the president.
Best friends with the president, and he's also tied up in these kinds of deals with OpenAI. So, it's not that it means that these companies will be totally wiped out, but whether we could see a significant drawdown, I mean, that's a risk. But in the long run, I think Dan is right. That AI is transformative. It is very different from any of the even industrial revolutions that we've had before in the past. And so in the long run, I think absolutely this is the technology of the future, just as the internet was back in 99. But that doesn't mean that we're in a scenario without the significant risk of a market crash. And again, don't take my investment advice. I'm not going to tell you what to invest in. You might actually be more on the Dan Ives side of the equation, but certainly that is a risk that we should be taking seriously. Now, that little pesky government shutdown that we heard about earlier has really overshadowed some other news out of the White House this week, and that was the new pharmaceutical tariffs that were supposed to take effect.
Right. So starting on the 1st of this month, fees for drugs imported into the U.S. with some conditions. It's always more complicated than that. These were planned, but there's been some deal making in the meantime. And for more on this, we're going to be joined by our DW colleague, Arthur Sullivan. He's been reporting on these pharmaceutical tariffs and joins us for more. Arthur, thanks for making some time to join us on The Dip.
Delighted to join you both, Kassandra and Daniel. Great to be here.
Now, this announcement, like many Trump announcements, came via social media post and was supposed to go into effect at the beginning of this month. Is it now in place?
Right. So that was what I was going to say when you were introducing it. It sounded as if this had been, well flagged in advance, as you would think something like this would be. But it came via a Truth Social post, which is Trump's personal network, just the other day, very much out of the blue. So even though this pharmaceutical story has been building all year and really throughout Trump's second term, it was quite a surprise that he made this announcement the other day saying that from October 1st there will be these tariffs. And the answer to your question, Kassandra, is no, the tariffs are not in place from October the 1st. But there have been developments. So this announcement that he made, he said that there would be 100% tariffs on, as he put it, patented or branded pharmaceutical products unless a company was building in America. So quite specific at that time. But now there's been a subsequent clarification from the White House that the tariffs are not in effect because they're trying to do deals with pharmaceutical companies. And they actually have already done quite a significant deal, which was announced just 2 days ago with Pfizer, one of the world's largest pharmaceutical companies and obviously one of the US's biggest. And this deal is really quite an interesting one because, again, it was a little bit unexpected. When Trump made this announcement the other day on the social network, there was this sort of expectation that, there would be maybe some scrambling from governments and that it would involve maybe bilateral negotiations like we saw with the so-called reciprocal tariffs. Wasn't necessarily expected that suddenly you would have these massive multinational pharmaceutical companies showing up in the White House, but that's exactly what happened the other day when the Pfizer executives announced this deal.
Let's chat a bit more about this deal with Pfizer. So is it actually going to benefit U.S. consumers? Because we know that healthcare costs in the United States are already really high.
Right. Well, this is quite an interesting deal. So yeah, as you rightly pointed out, and this is the key to this story, Trump, throughout his first term and indeed in his second term, has pointed out that the US consumers pay far too much for medication, for, as they call them in the US, drugs, Which is true. It's undeniably true. I mean, they pay in some instances 3 times more than people here in Germany or other countries in the EU would pay, and for the same medication, because they've just a different system of how they buy them. So he has consistently said he wants to bring those prices down. And this deal with Pfizer, so it's multifaceted, it's a little bit complex, but I'll try and quickly explain the main aspects of it. So Pfizer have agreed to reduce prices by up to 85% for certain medications. They even named some of them. For example, they named a popular migraines medication, one for dermatitis. They also have announced that they will significantly reduce the cost of medications on the Medicaid program. And for those who don't know, that's a program, a US government program, which provides subsidized healthcare for low-income families and individuals in the US. So it's not clear exactly how much more they're going to cut the fees there, but again, they've announced it. They've also agreed to spend $70 billion on US development of companies or of research and development, Pfizer, over the next few years. And they've had a general commitment to lower prices. Now, critically with all this, Kassandra, we don't know the full details. All we have to go on is the original post from Trump and then this press conference. But just one final point, crucially, which was made in that press conference. Howard Lutnick, the Commerce Secretary, when he was asked, he said, the tariffs are off. What we're doing now is we're going to try and do more deals with companies like Pfizer, and that's the way we're going to approach this issue going forward.
Yeah, some of these U.S. prices for drugs sometimes blow my mind. My mom lives in the U.S., and she takes the exact same drug that I do for a medical condition, and she pays way more than I do here in Germany. So that's just one anecdote. But I'm wondering, with this Pfizer situation, do you think that other deals are likely to follow with other pharmaceutical companies?
Well, it's been interesting to watch the reaction to this. So when the deal was announced, the share prices for a lot of these big pharmaceuticals went up quite a bit, by 5, 6, 7, 8%, because it was received as sort of good news by the pharma industry because it seemed to bring some sort of certainty. Now, the thing is, the deal that Pfizer has announced, and as I said, it is multifaceted, analysts have sort of said that the reason they've kind of readily agreed to this deal is they haven't necessarily made a huge commitment to drop prices massively, because it's not clear exactly how much they will drop prices, and they already subsidize quite a bit on the Medicaid program. So it seems like this deal works for Pfizer, it works for headlines for Trump, and it may well work to an extent for the US consumer. So other pharmaceutical companies are likely to get on board. Trump said Eli Lilly, another major one, he spoke very positively about them, seems set to announce a deal with them. A lot of the big Swiss pharma companies, the trade group that represents them, came out today and said they're all kind of keen to do a deal. I think there is an openness by these companies to do a deal because they probably recognize it's the easiest way to get it done. And the suggestion from a lot of these analysts who know a lot more about this topic than I do say that it's not necessarily that these companies are going to have to suddenly see a huge cut to their profits in doing this deal, but it will appease Trump. And it may well ultimately work out to an extent for the US consumer. But we, like with all these things, Kassandra, when it comes to Trump tariff announcements, you get the big announcement, you get the social media post, you get the kind of the drama and the headlines, but you don't get the details and you don't get the legal reality until a lot later in the process.
Now, a lot of the focus is on putting the cost burden onto other countries, especially in the European Union. What's been the reaction from that side of the Atlantic?
Well, this is really interesting because if you recall, back in July and August, the EU did this big trade deal with the US. I mean, it wasn't necessarily a big trade deal in the sense that a normal trade deal takes years to strike, but it was an agreement regarding tariffs. 15% tariffs on EU exports mostly across the board, which at that time it said would include pharmaceuticals. Now, the EU accounts for roughly 60% of all the US's pharmaceutical imports. So, it's a big deal. And it was quite clear in this agreement, it's 15% on those too. So the first reaction from EU leaders, like Ireland is a major pharmaceutical exporter to the US, Switzerland, which is obviously not in the EU, but it's, sort of often lumped in together in terms of these the process of negotiations when it comes to these matters. Also a big exporter, the Netherlands. They're all assuming that it's going to be on the 15% mark. And that's what, for example, the Irish foreign minister said. That's what the EU said in a statement. But who knows? I mean, we can't necessarily be sure with the way Trump has approached this issue before that he will say, well, yes, no, we've done a deal. It's 15%. That can't change. So their assumption is it's 15%. The 100% doesn't apply. But who knows?
Yeah, the devil is going to be in the details here. But zooming out, do you think that all of this can be classed as a win for the White House?
I think it's definitely it's more positive than negative at this point, because this is an issue that has actually united the Democrats and the Republicans for a long, long time. There is a general agreement that drug prices, medication costs in the US are far too high. It's really complicated to explain, and I don't even fully have my head around it myself, but it is to do with the highly privatized US healthcare system. And there are these middlemen, like pharmacies, who essentially, are like acting as middlemen between the consumer and the drug companies. And that was another important part, actually, of this announcement that Trump, to be fair, has been pursuing, that he wants to cut out the middleman. And part of this deal with Pfizer involves the creation of a government platform, which is, I think, going to be called something like TrumpRx.gov or something, which they say will launch next year, where, right, of course, has to have Trump in it, but that consumers will go on this platform and they will look for whatever medication they want, and they will be directed directly to the pharmaceutical company that provides it. And Pfizer has signed up, and they hope others will get along. So I think from Trump's perspective and from the White House perspective, it does bring you in the direction of lowering prices. It's unlikely to increase prices of medication. But again, we won't know exactly how good it is until we get a lot more of the detail in the months ahead. But at least it seems to be a step in the right direction for US consumers who for a long time have been paying too much for their medication.
Arthur Sullivan, our DW Business colleague, thanks so much for keeping it dippy with us today.
Pleasure. Happy to do so.
And I really loved that insight from Arthur, but you know what? We want your insights too, and your comments and your questions as well. Just leave all of your questions underneath this video on YouTube or any of our videos, and we'll try to answer them in our Q&A edition.
And of course, please like and subscribe to The Dip wherever you're seeing us or potentially only hearing us right now. And we'll be back in your feeds on Tuesday to do our best to answer those questions.
And that's it. You've been dipped.